Hi dreamers, I wanted to do an update of a video I made about 4 months ago where I predicted the outcome of ULTY. And let me tell you, it was a little bit rough as I predicted the downfall of this particular stock. And the reaction that I had was not pretty because of course everybody wants to believe that an 80% yield is the lotto ticket that they've been waiting for. So today I'm going to do a quick update of ULTY and some of the other YieldMax funds. And so to kick off this update, YieldMax has announced that 15 of their option income funds are going to go through a reverse split in December. And so in taking a look at their plan, on December 1st, there'll be 10-to-1 reverse splits of MRNY, ULTY at just over $4 now, and then a 5-to-1 reverse split for TSLY, XYZY, and YBIT. And then on the 2nd of December, you've got a 10-to-1 reverse split of Fiat and AIYY, CRSY, CRSH, DIPS, and even Coney, and a 5-to-1 reverse split of OARK and ABNY. And then on December 8th, a 5-to-1 reverse split of AMDY, MISTY, and PYPY. So as we take a step back, what does a reverse split of these mean? Why is it happening? And how have some of the most popular of these funds performed over the last year? So first of all, what is the reason for a reverse split? And there's a few basic ones. The first is to avoid delisting. And this is the most common one because a fund has to meet a minimum share price in order to stay on the stock exchange. Another main reason is to improve perception and image. If a stock continues to fall lower and lower, it's often perceived as a sign of financial distress. And so a reverse split creates the appearance of a more valuable and stable company or fund. And another one is to reduce administration costs by reducing the number of total shareholders. And a lot of companies, including YieldMax, will argue that a reverse split doesn't change your investment because the value is the same no matter the number of shares. But I'm here to tell you that a reverse stock split is basically not a good sign. So let's take a look at some of the most popular YieldMax funds. Now that we have a good year of back data, well, you can see the price return here, with the price of ULTY going down 60% over the last year, TSLY down about 50%, MISTY down about 77%, Coney down 72%, and Navidny down 41%. But of course, all of this is about the total return with that juicy dividend. So let's change our metric to total return, and the results are in. What you see here is a negative return of about 5, and that means that if you bought ULTY 1 year ago, you would have lost 5%. TLSY had an 18% increase, MISTY a negative 41% total return, which means you've lost about 40% of the value. Coney with a negative 30% loss, and NVDY with about a 19% return. And of course, if you held the underlying Tesla or the underlying NVIDIA, you would have done much better with about a 30% total return for NVIDIA and a 25% total return for Tesla. So even on these two stocks, the YieldMax version produced a drag on the returns. And why does that happen? Well, there's a few reasons why. Such massive NAV erosion creates a problem for investors, and it goes something like this. The number one reason is the loss of principal, because as investors lose initial capital over time, the distributions are partially funded by returning their own money. And with that, the fund's share price continues to drop over time. And then, as the fund's total assets shrink, it has a smaller capital base from which to generate the future income, in this case creating options contracts. And this then leads to a downward spiral of lower assets and subsequently smaller distributions. And in the event that there's a pop in the market, there's also capped upside potential. So many high-yield strategies inherently limit the fund's ability to capture capital gains, especially when it's an aggressive options strategy. And so as I pointed out 4 months ago, my update to ULTY is this. This fund picked volatile tickers, the most volatile tickers in fact, And to get the very high yield, they created aggressive calls and puts, including on some leveraged tickers, which upped the risk factor even more. And unfortunately, this was done on some tickers at their all-time highs, above 70 or even 80 RSI. And when you add all of that to a very high cost structure and a very high distribution, the result over time is a drawdown of principal. So my dreamers, I hope we've learned a valuable lesson about these YieldMax or even any ultra high yield distribution funds, that the high reward often comes with ultra high risk too. Let me know what you plan to do about these funds in your portfolio. And as always, let me know what you think in the comments. Well, that's it for today. I hope you enjoyed this dividend income update. And if you want a richer, real-time experience with me, you can always follow me on Instagram or X. And if you're doing your own research using Seeking Alpha, feel free to find the link below to subscribe if you want, no pressure. As always, I encourage you to do your own research, then implement and learn by putting it into practice. And as a reminder, I'm not a financial advisor, so keep in mind these videos are for entertainment and inspiration only. I'll see you on the flip side.